Hey everybody, this is Coach D with TackleTrading.com here to talk to you about return on equity. Return on equity, also known as ROE, is the amount of net income returned as a percent of shareholders' equity. Return on equity, also known as return on net worth or RONW, measures the corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. The calculation for return on equity is relatively simple. ROE equals net income divided by shareholders' equity. ROE is typically expressed as a percentage. ROE typically measures an entire fiscal year and is calculated before dividends are paid to common stockholders, but after dividends are paid to preferred stockholders. Shareholders' equity may not include preferred shares and is sometimes called return on common equity, or ROCE, which is net income minus preferred dividends divided by common equity. Boy, that was a mouthful. Here's a quick look at some fundamental data on Apple, and here under the profitability section, you'll see the return on equity. And the current annual return on equity is 36.86, which is pretty solid. Year over year, that's down 10%, but that's a pretty solid return on equity. And you can look back over the last several years, 2013, 14, 15, 16, 17, and you can see what typical return on equity has been for this particular corporation. Let's compare and contrast that data with Microsoft, where here again we see that profitability section. Here's our return on equity, and we see here that their return on equity is 29.37, and if you look back over their historical ROE, you'll see that that's not as high as the previous equity. So there you have it, ladies and gentlemen, return on equity.